Financial statements are essential documents that provide a comprehensive overview of a company's financial performance and position. There are three main types of financial statements: the income statement, balance sheet, and cash flow statement. These statements are used by various stakeholders, including investors, creditors, management, and regulators, to make informed decisions about the company. The income statement, also known as the profit and loss statement, reports a company's financial performance over a specific period, typically a quarter or year. It includes components such as revenue, expenses, and net income. The primary purpose of the income statement is to show the company's profitability and financial performance, indicating how well it generates profit from its operations. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It consists of three main components: assets, liabilities, and equity. The fundamental equation of the balance sheet is that assets are equal to liabilities plus equity. This equation ensures that the company's resources are balanced against its obligations and the owner's interest. The cash flow statement reports the cash inflows and outflows of a company over a specific period. It is divided into three main components: cash flows from operating activities, investing activities, and financing activities. The primary purpose of the cash flow statement is to show the company's liquidity and cash management, highlighting how it generates and uses cash. Interpreting financial statements involves using various analytical tools and techniques. Ratio analysis employs financial ratios to evaluate different aspects of performance, such as profitability, liquidity, and solvency. Trend analysis involves examining financial statements over multiple periods to identify patterns and trends. Comparative analysis compares a company's financial statements with those of industry peers to assess relative performance and competitiveness. Financial statements are crucial for understanding a company's financial performance and position. The key financial statements include the income statement, which shows profitability, the balance sheet, which provides a snapshot of the financial position, and the cash flow statement, which reports liquidity and cash management. Analytical tools such as ratio analysis, trend analysis, and comparative analysis help in interpreting these statements, enabling stakeholders to make informed decisions.